So our business, and I spent the last 3 years flying around the world trying to attract capital to agriculture, and it is incredibly difficult to attract capital. I mean, you need to break down good capital and bad capital, and in my passionate opinion, there's a huge difference, and we've got to be very careful what we wish for in terms of attracting capital. Two sorts of capital, obviously, debt capital and equity capital. We heard today that grazing or cattle was running at 300% sort of debt to GDP on a real basis. I think on the aggregate in the rural industry, that's about 130% or something. So we're in high territory in terms of debt to GDP. So we don't need more debt capital, period. We've got too much as an industry. If we get margin expansion, that's fine. We'll grow out of it like a bad haircut. But so we need equity capital, not all of us. And how do we attract that, and what do we look for? So the bad capital, the capital we do not want quick capital. We don't want capital to come and make the highs higher and the lows lower. So we need very long-term patient capital that understands the asset class. We don't want the quick flip private equity style capital that will come and just try and sort of engineer the financials and flip it onto a bigger fool. So the Australian pension funds get a lot of criticism from agriculture about not investing, and you'd have to say net they've been better off by not investing in agriculture. You know, it's not a right for them to have, you know, we need to earn their attention. We need to create some envy in terms of good results of investors coming and making good money. You know, you have to remember that the money in our pension funds doesn't belong to us as a nation. It is, you know, defined benefit pension schemes, and it belongs to the hard-working, you know, public service and police and nurses and whatever. So, you know, it's not for us to say, well, they should support us because, you know, we deserve capital, right? Firstly, that's the first point. The second point about Australian pension funds is that we have a very high hurdle rate here because our interest rates are higher. So, you know, our interest rates here are some of the highest in the world, in the developed world. So, by nature, these pension funds have that as a benchmark, so they don't get a bonus unless they outperform that hurdle rate. So the best money, in my opinion, is North American money, pension fund money, and Canadian money, which is sort of Midwestern pension funds. The funds that are regional, there's trillions of dollars in regional America and Canada. And the Australian superannuation industry, as well as you know, we've just launched this freedom of choice for people to be able to choose their superannuation provider, which means that our superannuation industry has to make a much larger provision for liquid assets. So by nature, agriculture is not liquid, so you know that makes it harder as well. So don't fret about not having Australian capital. I would say you're probably better off not having the Australian pension fund money. Have a lower hurdle European. So that's the capital question. And what are they going to look for? Well, they're going to instantly have a benchmark they've got to jump. So the first question is, what is your cash hurdle? And they're always going to be, Peter Donnelly asked or made a statement about, you know, value in business on a multiple, and that is just how the capital markets think. That is how everyone should think. This relative valuation methodology is an absolute nonsense, and it's led us to where we are today. It's irrelevant what, you know, you cannot price these assets like gold or art or stamps. It's just, it's a folly, and we've learnt that now. So back to the Kidworth people, they've been crucified fairly well today. I actually typically did my homework on the school bus with Rob about 5 minutes ago. I hadn't had a chance to dissect the accounts, and I just spent 5 minutes looking at that, and I just broke it down. And this is how we think, and this is how the capital markets will think. Firstly, they don't really care about your capital structure. They don't care how much debt you've got. They want to look and see, are you a good operator or are you not? And I looked at the Kidman stuff today, and they're actually pretty good operators. If you strip out, you have to strip out their interest bill because it's irrelevant, because these guys will just price everything on a no debt basis, and then they can apply debt as they see fit. You have to strip out the depreciation because it's totally dependent on what capital they've deployed over time or whatever, and you can add that thing in later on. And you have to strip out all the abnormals, like you know, having to feed all your stock, and the abnormals like forced sales and blah blah. So when you actually, and this is very very rough because I did in about 5 minutes, but when you actually look at the and normalise those financials of Kidman, they're making an EBIT per livestock unit of about $120 or something like that. And when you look at all the benchmark studies in this area in Northern Australia, that's pretty good. No one we back will ever make a capital allocation decision on their own. They will put a business case forward, and we'll decide whether it jumped the cash hurdle or not. So I've spoken enough. That's all I've got to say on that terrific question.
Tim's just bailed about. Kidworth's fine and dandy. Talk to Tim.
They've obviously got some serious capital or balance sheet problems, and the solution, if you're wanting one, is, I sort of agree with everyone today, there is no quick fix solution. They need to find out mentally how they're tracking, and I could probably guess that probably not mentally not well, which is an issue. If they really want to be farmers and that's their home, then there is a lot of options. I mean, they can sell 70% of their assets and lease them back if they want. They can, there's lots of people doing that. That they would attract capital with if they were made what we call roadshow ready or investment grade in terms of going, righto, here's the average returner, which is in this area probably $45 of EBIT. Ask David Council or someone will know the figure better. We're doing 114. We've made some really bad decisions where we acknowledge that. It's got us into trouble, but we can't do that again. So it's a balance sheet workout solution.
Who do they go to for that? Who do they go to for that leg up?
Okay. Again, it gets back to probably what Rob was talking about today in terms of scale. We have a minimum bandwidth of what we can look at, and for us to do a deal, the last deal we did, we had to underwrite $1.5 million worth of broken deal costs before it closed. In terms of it was 426 days. So, there's no such thing as quick equity capital. It doesn't exist yet, and when it does, the prices will be too high. You won't be able to afford to buy anything. So, who do they go to? They would start with an advisor, and Bill might have some opinions, and Don, but you need advice. You cannot. There'll be almost no one who's investment grade now. And it's all the stuff that doesn't make any difference to your P&L or your bottom line. It's all perceptions and theatrics. There is a wall of money coming to agriculture. You can hear the Hooves coming. We see it. We travel the world. What's happening now in the asset allocation business is there is we now have an asset. We now have a basket we sit in agriculture. It's called real assets, and most of the big pension funds in the world are now having a real asset allocation, and that's mining, resources, commodities, renewables, and agriculture. So agriculture actually fits in there now. So 3 years ago, we started marketing. We didn't actually know who we were going to visit. We didn't fit into a bucket. So the capital's coming. And on the livestock side, what we forget is that when you look at the rate of change of commodity demand across all the complexes, by far the most rapid rate of change of demand is the livestock complex. All the livestock products from proteins to dairy. And then when you look at the numbers, you look at the global stocks to use ratios of beef, and we're now down to 1%. It's the lowest. I've got data back to 1960, and it topped out in 1990 at 4.5% or something. So we're really running our stocks down to critical levels. And then you look at the numbers, and the global herd we heard today was back, down to 1978 levels. You look at the sheep numbers globally. Sheep numbers are back to 1990 levels, and in Australia, sheep numbers are back to 1916 levels. So we have the perfect storm, and I would just say, hang in there. It's always darkest before the dawn. Someone much smarter than me once said, and I see it all the time, that those most closest to things normally miss the big moves because they're so bashed around the ears by the time things bottom out that they just give up, and they're so glad to get the first uptick and get an exit. And we've all been in that position, and so I'm just incredibly bullish on this, and I have no idea when, but I suspect sooner rather than later. We're also entering, in my lifetime, I passionately believe we're entering a wildly inflationary environment. We cannot, in the developed world, grow money supply, at about 5 times GDP and not inflate. So, owning land is the ultimate in real asset inflation protection, and the world's starting to realise that. So they're flicking from paper money, bonds that are yielding 1% in the US to real assets. So, the money's coming. It's a matter of taking advantage of it, and it will create bigger cycles, and you have to be a contrarian in this business. We don't operate in the normal business cycle where earnings just sort of tick up, you know, aggregate earnings on an economy will tick up at CPI plus GDP growth. Over time, we are cyclical, commodities mean revert, which means you just have to be a contrarian. When everyone else is buying, you have to be selling. And when the money comes in and pushes prices up, they'll get redemptions as well, just at the lows and whatever. So for the next generation, fade those moves, and I think everyone will make a fortune.
Hey, ladies and gentlemen, how about that to end on a really positive note?
People can create real opportunities for each other, and I implore you to join AgriHive as a platform to be able to explore those opportunities and to build resilience in our rural regions.